is interest rate risk. So we're going to go through a couple practice problems. The sensitivity of a bond's price to changes in interest rates is measured by something known as the bond's durations. Bonds with high durations are hardly sensitive to interest rate changes. Bonds with lower durations are less sensitive to interest rate changes. Bonds with longer maturities have higher durations than bonds with shorter maturities. Bonds with lower coupon rates have higher duration than bonds with higher coupon rates. What's the lowest the coupon rate can be? 0. So a long-term 0 coupon bond would have the highest duration and the most price changes to any given change in interest rates. Let's just look at a simple example of bonds with different prices and different yields. Here is, in this color blue, the yield changes over time, and that gave us the bond prices over time in this same color blue. If yields were 6%, you can see bond prices would be lower. If bonds were 4%, if yields were 4%, bond prices would be higher. At maturity, their bond will equal the face value. Now, which has more price risk? Which causes prices to move the most with respect to an interest rate change for the same coupon, a 1-year or a 10-year? Well, we should expect the 10-year, it has the higher duration. And in fact, we can see if we look at a 10% coupon bond for both the 1-year and the 10-year, you can see at 10%, they're both trading at par. If yields go down to 5%, the price goes up. If yields go up to 15%, the price goes down. And which has the bigger changes? The 10-year. We can see that graphically, how the price changes with the changes in yield to maturity. The relationship between price and yield is steeper for the 10-year, flatter for the 1-year. Now, there is another type of interest rate risk known as reinvestment risk. That is the concern that yields will fall and future cash flows will need to be reinvested at lower rates, thereby reducing income. Suppose you want $1 million, you want to invest the money and live off the interest. So you can invest in either a 10-year bond or a series of 10 1-year bonds, both of which are currently yielding 10%. If you choose the 1-year strategy, you'll receive $100,000 in income and have $1 million to reinvest. If interest rates drop from 10 to 3, your annual income will fall to $30,000. If you're in the 10-year, you've locked in a 10% interest. You'll get that $100,000 each year for 10 years, assuming the bond is not callable. So we see that short-term high coupon bonds have low interest rate price risk, but high reinvestment risk, and vice versa for long-term low coupon bonds. Nothing is riskless. Let's look at another example of practice problem. Semi-annual 10-year 8% coupon, face value $1,000, yield to maturity 6.5%. We're going to have interest rates fall 0.75%, and look at the percentage change in the bond after a change in interest rates. We're going to look at a 10-year and then at a 2-year. So to price the bond, remember we put in future value, here is 1,000, payment 8% coupon, 8% of 1,000 is 80, but we divide by 2 because it's semi-annual to get 40. Similarly, N is 10 years, we multiply by 2 to get the number of 6-month periods, and we divide the yield by 2 to 3.25 for the yield for semi-annual. and we solve for a price of $1,109.04. After the interest rate change, now the yield is 5 3/4, gone down by 3/4, or 2.875 is the periodic yield, and we solve for the price $1,169.32. Of course, we expect the bond price to rise because interest rates fell. The percentage change in the bond price, the new minus the old divided by the old, is 5.4%. Now let's look at it if this were a 2-year bond, everything else the same. Again, the same payment, the same future value, the same yield, but the number of periods, now 2 years is 4 periods. Now you see the bond price is $1,027.71 before yields fell, and after yields fall, the bond price is $1,041.94. The price change is 1.38%, less price change with the lower maturity, even though it's the same change in yield. Thank you.